All right, let's dive right in. We are looking at a market analysis as of March 11th, 2026. And honestly, we're at a moment that is shaping up to be one of the most fascinating and maybe one of the most dangerous times for investors in a long, long time. Sometimes you read a sentence that just hits the nail on the head. This line from a big institutional research note, it perfectly captures the massive conflict that's driving absolutely everything right now. It's poetic, sure, but it's also a brutally accurate summary of the war being waged for the soul of the market. Because what we're seeing is a tale of two completely different markets. It's like on one hand, we've got the ghost of the 1970s haunting us with stagflation. And on the other hand, we have this sci-fi future driven by AI that's arriving way ahead of schedule. These are two totally opposite economic stories happening at the exact same time. So today, we're going to break down that collision. Okay, Act 1. Let's start with the scary stuff. Let's explore this powerful narrative of fear that has its grips on the traditional physical economy. I mean, this is the story that is keeping central bankers up at night. So what exactly is this threat that has Wall Street so freaked out? Well, it's called stagflation, and it is pretty much the worst of all possible worlds. Imagine everything getting more expensive, while at the same time the economy stops growing and people start losing their jobs. It is an absolute economic nightmare. So where's all this fear coming from? Well, it's a classic story, really. It all starts with a sudden, dramatic shock to the world's energy supply. See, when the cost of energy spikes, it acts like a tax on every single part of the economy. We're talking everything from shipping goods to you just driving to work. And look, this is not just a theory. The data backing this up is, well, it's stark. Take a look at these numbers. Crude oil has shot up to $88 a barrel. And at the same time, the economy didn't just slow down, it actually lost 92,000 jobs last month. This combination right here, this is the classic signature of stagflation starting to take hold. Now, let's talk about the cost of money, because this is huge. This number, 2.13%, is the real yield. The easiest way to think about it is it's the interest rate you pay after you subtract inflation. And when this number explodes higher like this, it puts an immense, crushing pressure on anyone with debt, from huge corporations all the way down to the banking system itself. It's like a vice grip tightening on the economy. But, okay, at the exact same moment all of that is happening, there's a completely different story being told, an incredibly powerful one coming from the tech sector. And it's a story of pure defiance against all the old rules of economics. I mean, check this out. Just last night, we got a massive piece of evidence for this other narrative from the tech giant Oracle. Their cloud revenue, it jumped by 44%. Now, in this kind of economic climate, that kind of growth isn't just good, it's absolutely staggering. It proves the AI boom isn't just hype, it's turning into real, massive piles of cash. And if you think that's a one-time thing, think again. This number shows a 325% increase in their future contracts. What that means is companies are lining up and locking in their AI spending for years to come. This demand for AI infrastructure, it's not just growing, it's a freight train with no brakes. So what's the big idea here? Well, the crucial point is that investors are now betting that this AI-driven growth is a force so powerful that it can literally defy the economic gravity that's pulling everything else down. The theory is that AI can make companies so incredibly efficient that they can just absorb higher costs and keep on growing, basically creating their own economic weather system. So Act 3. What happens when these two giant forces collide? How does this all translate to the market? Well, it's creating a fundamental split. You absolutely cannot look at the market averages anymore. You have got to look underneath the hood. And this table just shows the split perfectly. The top arm of the K is soaring. You've got energy loving the crisis, and you've got tech riding that AI wave. But then look at the bottom arm. You've got financials, real estate, consumer staples, all the sectors tied to the old physical economy, and they are getting absolutely crushed by high rates and soaring fuel costs. Now, this divergence actually has a name, and it is the key to understanding this entire market in 2026. It's called K-shaped macro. It's not a recovery for everyone. Nope, it's a great divergence between the digital world and the physical world. And get this isn't just some academic idea. The biggest banks on the planet are placing their bets on which side of this K is going to win. You have Goldman Sachs in one corner, basically all in on the AI boom. And in the other corner, you have JP Morgan sounding the alarm, warning that the traditional economy is about to break under the strain. So, the big question, right? How in the world does an investor navigate a market that's being pulled in two completely opposite directions? Well, the path forward requires a really clear understanding of the possible outcomes and the hidden risks. So, the report lays out two very clear potential futures. It's like we're at a fork in the road. In scenario A, the AI Goldilocks world, the good news from tech wins out and everything is great. But in scenario B, the stagflation shock, the bad news from the energy markets just overwhelms everything, and that could trigger a serious market crash. It really feels like a binary, one or the other outcome. But what if there's a third option? The one that nobody really wants to talk about. The report highlights a black swan risk, a danger that's kind of hiding in plain sight. It's a threat that connects both of these worlds, high interest rates and murky finance. The fear centers on something called private credit. Think of it as a multi-trillion-dollar shadow banking world that operates outside the normal rules. With rates so high, the big risk is that these loans start to go bad. And if all the investors in these funds try to pull their money out at once, well, that could trigger a sudden liquidity crisis. Sounds a lot like 2008, doesn't it? And so the report leaves us with this final piece of advice. In an environment this chaotic, just betting on hope, well, that's not a strategy. The only real safety, the only real umbrella in this kind of storm is found in companies that are so dominant they can raise prices no matter what, and that generate so much cash they don't even need to borrow. So that is the ultimate question for investors today. Who has the power and who has the cash?